All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I said to my brother last night, I said, if this market opens up higher today and we see it continue to run throughout the week, it is perhaps one of the most Teflon resistant or most bad news resistance markets that I've ever seen. I've seen markets where we've climbed the wall of worry. I've seen markets where, we've scaled, Ebola and in all different other concerns. We've scaled concerns with economic growth and earnings before. But when we look at the divergence right now between the economic data, between the yield curve, and between the market, it's remarkable. It's absolutely remarkable. I think you could argue October 2007 is when maybe the market was September, October 2007, where the market was this kind of resistance to bad news, and was willing to buy up even the bad news, which is, let's face it, that's what we're seeing. That's what we are seeing here overall, and so very much a Teflon style market. And I was asked, hey, why is this happening? Well, the reason it's happening is not. It's not a mystery, right? And we've talked about it, and I do apologize for my voice. I've delayed getting on video as long as I could to try to, get my voice 100% in here, but doesn't sound like it's going to happen. But overall, the reasons for why this market is going up, they're very clear, right? We've talked about the two components. The one is the fund manager component, right? Where fund managers are in positions where they can't be on the sidelines, right? I hate for the challenge being on the sidelines as market's going up, or being on the downside when the market's going up, but I have a very limited risk, a very limited scope, right? When it comes to a fund manager with billions of dollars in play, they can't be on the sidelines. They just can't. And we had an absolute historic first quarter here to the year, and there's so many ways that we could show the historical nature of it. And so fund managers just can't be on the sideline. They can't look at their percentage and go, oh, well, great, our fund's up 5% this year, that feels good. No, it doesn't feel good at all. In fact, it's a way that they can lose their jobs. It's a way that they're going to lose. They're going to lose most importantly clients. And when you look at the S&P here this year, and we put on in fact, let me just clear out all the mess in here, all the indicators. But we just come on and put a performance chart for year to date, and we look at what the market has done performance-wise. It's up 14.5%, right? If you're a fund manager and you're up 10%, what do you have to do? You have to chase. If you're up 5%, you have to chase. You can't sit. You can't sit behind and go, well, you know what? The fundamentals are actually eroding. The earnings are actually eroding, because when the bottom line comes down to it, nobody cares, right? Nobody's going to care. You could sit on that sideline, and maybe some fund managers do have that opportunity. They are afforded that luxury because of past performance. But in general, no, they're forced in. Right? You think about the .com bubble, right? And I'm not. This is not the .com bubble, right? This is not the same thing. It's not even close to the same thing. But you think about the .com bubble, fund managers didn't want to buy, pets.com, right? They look at it and go, that's ridiculous. But it keeps going up. And it's up 50%, and it's up 80%, it's up 120%, it's up 200%. Eventually, they have to get something in there. They can't sit on the sidelines completely. And that element of being forced in off the sidelines is what we're seeing happen right here. Now, what happens afterwards? Well, you know what? Every time we see a very forced period, we know what happens afterwards, right? We absolutely know what happens afterwards, and it will happen again. When is the question, right? And we've seen a few signs of some cracks in the market internals, coming in, But even with those, we have not seen the Bears be able to take anything. The chasing in has been very strong. So we have that element. One, the fund managers, and number two, the U.S.-China trade talks. And the longer it goes on, the more the market looks and says, okay, fine, the economics are getting worse. Yep, earnings may contract this year a little bit or not have the same growth as they've had. We may see those things, but it's okay because we have a magic pill, and it's called the trade deal. And it's a magic pill. It's going to fix everything, and that's the market mentality right now. And you know what? Ultimately, they may be right. They could definitely be right. But those two functions, this magic pill for the market, along with the what's it called? The fund managers being forced in, and then you add the Fed on top of that. You add the Fed, where basically every time the Fed speaks, what's the market do? It goes up. The Fed has been highly accommodative here to start this year. They completely changed their tone from last year. They've completely changed that dynamic. We could talk about the politicism of the politicism of the Fed here, and how that is changing, and it is, and it's kind of a not a good commentary on things going forward, but it's a reality of what we're seeing out there, and it is really kind of put a positive push into equities here as well. So is this going to be a trade deal gets signed and everybody sells the news? Buy the rumor, sell the news. Yeah, it could, right? But we could also get a report that, hey, you know what? They're going to sign partial and they're going to work on other things for the next 3 years. It's something that could be in the market for a long time to come. So those are the whys. That's why things are going on higher here and pushing on higher. And when we talk about, when I use the word Teflon for the market, this is what I mean. Here's FedEx. If I told you FedEx was downgraded this morning, would you believe me? It takes a lot for a company whose earnings were subpar, significantly subpar, whose outlook actually weakened. And then the stock, okay, fine, it rallies on back, but then to push to a new short-term high on a downgrade. I mean, you see this in small-cap tech names every once in a while, where this type of action happens. But in a Dow component, in a FedEx, to see that type of action, you just don't see it. You just don't see it, on a consistent basis, or even on an anomaly very often. But that's what we're seeing, and it is one of those markets where, I think the best word to describe it is Teflon right here, and that is, all the bad news just slides right off. Now, if we go and look at, good news, bad news, if we come here to Econo Day and look at just what the economic data has looked like, there's some interesting mixes here. The European data was atrocious. I mean, the European data, PMI data out of Europe, terrible. It's one where, you start throwing around the word recession when you start seeing these types of numbers. I mean, here's the German PMI manufacturing index. Came in at 44.1. 50 is neutral. Not only is it 44.1 in missed consensus, but it's well below the prior. It's contraction and decline, and this is very different than the rest of the other economic data we're seeing, where the economic data is still growing. It's just the rate of growth is slowing. With Germany, it's starting to look like this, where the rate of growth and the decline is, the rate of growth is actually negative, and there's a decline in the data, right? And so we see this kind of really ugly piece of data here, worst performance in more than 6 years, and a big slump in new orders, which is what matters the most when it comes down to these as far as looking at what's going to happen going forward. So it's a very ugly piece of data. Did the market react? No, S&P futures barely flickered. barely flickered. You say, well, maybe because France is doing really well. France pushed into contraction. You can see last month 51.5, this month 49.7. They pushed into contraction. Well, what about the overall Eurozone? France and Germany are just, two big pieces. But prior 49.5, actual 49.5 this month, and a huge drop. A huge drop. And not only a huge drop, but a huge drop in new orders out there as well. Then we get to U.S. retail sales. This is generally okay. You know what? It's a number that the market historically reacts to sometimes, and sometimes it just kind of sweeps under the rug. Well, here's retail sales for February. Prior was 0.2%. It was revised up to 0.7, so that's strong, right? That's a nice little revision there. But expected to come in at 0.3, came in at minus 0.2. I mean, blue even broke the consensus range. In any way you look at it, negative, 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 right? But again, market reaction, a 1.5. 1.5. Market didn't care. Market just didn't care and just said, no, we're going on higher, right? What about U.S. PMI? PMI manufacturing. This is that piece of data showing the, like what we saw with Germany and France, 52.4, right? So lower than the prior month, lower than what the flash number was, but not in the contraction phase yet. Not like Germany or France or the Eurozone, which has pushed into contraction area. Still an expansion area, but slowing of that expansion, right? ISM. The ISM number. This is one of my favorite numbers, out there to take a look at. Here we see a difference. Here we see something a little bit different. We saw it come in at 55.3, actually beat the consensus here and beat last month's number. A little bit of a snapback here, right? A little bit of snapback here with this, with this ISM. Now, is it a strong number? Is it one where we look at and say, well, you know what, this has really strong future ramifications? Well, let's go take a look. Let's just kind of look at the internals of this number, and here we go. Most recent, and one of the areas I always want to look at in this report are the new orders, right? The new orders; those are going to matter the most. And here we have the March number of new orders. Here's the February number of new orders, and we actually see a nice bump up here in new orders. We also see a bump up in production, right? Both are very, positive. We see a decrease in inventories. That's actually a positive. Customer inventories rose, but they've been very low for a while. We see pricing bumping up, which is an actual positive. Backlog of orders going on down, which is a positive. So the areas where this number is weakening, they're positives, and the area where the number is strengthening, they're negatives, they're positives here as well. So, we did have the import and export orders kind of weighing on this number. You take imports and exports out, which is what the market is doing. The market's taking these out. The market's saying these don't matter, right? They're taking these out because they say, hey, there's this magic pill called a trade deal with China. That'll fix this. And you start to look at all the other stuff. It's a very, very positive number here for the PMI data, and in right there in the mix of a negative retail sales and what we saw out of Europe, here overall. So again, continued kind of mixed data, but which data is the market reacting to? It's reacting to the positives. Now we also saw China data here overnight, and let me come here to it. Here we go. But the PMI manufacturing here for China, and here's the number. Came in at 50.8. So moved from contraction into a small little pace of expansion, and the fastest growth pace since August of last year. Now, what happened after August of last year? Everything fell down. But, it is the fastest growth pace since, and actually above 50. there with that with that number. If we back out and go to the more private version of a government number, it shows the same thing. Right, came in at 50.5. This has been a number in contraction, but sharp gains in new orders and export orders helping to push that up. So we have some real drudgery going on there in Europe. We have very mixed data here in the U.S. and a little bit of pickup, a very minor pickup here in China, and then in Japan. Let me just kind of show you Japan here. Again, contraction. We're still in the contraction phase for Japan, but nobody's cared about Japanese economic data for 10 years. So that's kind of what this market is. And when you look at what futures did on semi-positive data, they jump. And when there's negative data, they just barely budge, barely move. Market doesn't care. That's the environment we are in right here, right now, which for a bear is a very disheartening environment, because all the normal things that tend to happen before a rollover are absolutely happening, and then there's no rollover. There's not even a correction. There's no real pullback, coming into the market, and that's what we are seeing right now. We are just absolutely in that choo-choo runaway phase, and one that we've talked about. What's the potential here? Well, the new high potential. I still contend that the potential drop is definitely bigger than the potential pop. But the way we continue to see the market act, the way we continue to see it react to the data, it is one where, at least here in the short run, continues to be, very, very just kind of shake off anything and move on higher. Now, in my note this morning, I did mention I thought today could be a very interesting day in terms of one of those days we look back on for a while and go, wait a minute, there's something major here. Today mattered. I don't think it's going to happen in today's candle, meaning, we're going to say, well, today's candle, this is huge. I think this is going to be just one of those where if there's a gap down tomorrow, it's probably going to be news related. And if there's a gap down on news related, it will create a little bit of an abandoned pattern here, similar to back in here. It will also be one of those where if it continues to gap on up, it'll be looked at as, hey, this is the breakout that happened before the market hit new high. And, I think that's why we will, be kind of looking back at this number and saying, hey, this number is, or today's action has some import there. Now, in terms of the metrics, we did see the market vibe turn neutral last week or on Friday, go from bearish to neutral. We see the bullish percent index pushing up higher here, but you'll notice bullish percent index, is not up even near its highs. It's still a ways off from its highs. It has not triggered into a bearish phase, but, is nowhere near its highs. We continue to see a little bit of lag in the IWM in the small caps. We have the Dow breaking new highs, SPY breaking into new highs. Small caps still about 2.5% off their highs. So, we still see this lagging small cap action, out there in the market. We see some of the emerging markets, they're kind of equal performing, here with the bump up the last 2 days and something like the EEM here, and then the FXI, getting some of that, similar type of bounce and rebound associated here to it. So, it's one where right now, as it sits, the market vibe is a 3 with a neutral reading, but it would only take going to a 4 today to trigger bullish. So we'll see, where that ends up here by the end of the day. I think from just a pure trade standpoint, it's still the same trade for the bulls. You buy based off of this morning's high. The Friday you buy based off of Friday you buy based off Friday's low. Today you buy based off today's low, right? And that is the way these things. You trade these things. You trade them off of the low from the prior day. So here's something like J&J, right? If you're buying J&J off of Friday's low, kind of stinks that today's down, but not really breaking Friday's low yet. And you put it and you say, all right, wherever it ends today, as long as it doesn't break Friday's low, you run with it. There are other stocks that are just a little more dynamic. Here's Micron, right? Now you switch Friday's low to today's low. If you want to be a buyer, use today's low as a stopping point there for it. And I think that's kind of, regardless of how you're looking at some of these, regardless of your technicals and whatnot. I think this is just going to be the way that the market plays it right now, simply because there are so many fund managers in that force chase mode, and they're not going to be too patient if things start to fall. So hey, forced mode in, all right. I'll buy off today's lows and go, and you know what? You can continue to run with it as long as that forced mode is in, and then if it breaks today's lows, you say, hey, you know what? All right, I'm out. If you're bearish, you've got to wait for to set up new stuff. You've got to wait for the lows the lows from the prior day to break. Either that or you're trying to top pick, right? You're trying to top pick. And if, you look at something like the SPY and you put in, even some short-term overbought, oversold indicators into the SPY, like the CCI. The CCI's come up to 200, but nowhere near 300, right? We have the MFI pushing above 80, so that's in an overbought position here. So we are seeing a little bit of overbought come in, but it's nothing, super conclusive. I think from a bearish standpoint, you look and you say, hey, at this point, you need a gap. You need a gap to sell into, and then be able to use the high ahead of that gap as as that stopping point overall. Okay, so I think both ways it's very easy, very clear as far as looking at it from a market dynamic in which way and how to trade it, and in which way you want to go from a risk-reward standpoint. And if I had cash free for the challenge, I'd be looking to do this. Now, my cash is tied up, in Home Depot and EM. Now, they both have plenty of time, but, we do need to see some hard, fast selling, start to come in. I do think we will see it. I do think we will see it. It is something that, I expect to see. When will it happen? This week, next week? I'm not sure. I think there's a good possibility that today marks the high in the market. And, but at the same time, I know that the news factors there, do have to change here just a little bit, for that to occur, for that to take place. Now, one last thing, and I was asked to kind of look at this, and that's bonds, the TLT. This is a big move down in bonds today, right? That tells you the market's looking and saying, ooh, the economic data looks better, right? That's what the market is pricing. And, anytime we see a breakout, especially a big, bad breakout like this, there's always a chance of that breakout coming and retesting before going higher. I think that's what we're looking at here with bonds, is just that kind of retest before going on higher. U.S. dollar pushing into new highs, which is pretty. It's just one of those where the bulls have their cake and they're eating it too. To say, hey, market's hitting new high with the U.S. dollar hitting new high. That's just not something we typically see, and then we look at something like gold, the GLD here. We're not really seeing much of a bounce as the U.S. dollar, is pushing into that, pushing into that new high, here overall. We're seeing the miners kind of fall off today. This is something where, keep an eye as they get down here to 21.5. You've been looking for a position to get in. There's going to be a nice position right down there, especially if we see a little breakdown in the U.S. dollar, here later on this week. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.